Hello everyone, welcome back to the channel, your number one source for income-oriented investing. And I just want to do a follow-up on my recent video where we discuss the reverse split 1-for-3 for QQQY, JPY, and the Russell one, because I still feel like some of you are still not understanding it or getting it. And what I'm about to say, I probably repeated a million times, but it's okay. I mean, I feel it's really important that I owe it to you guys to educate you, make sure you really understand what these funds are, what they mean if you're investing in them, and you got to understand how they work. And I'm not really going to talk about really the reverse split, but what I wanted to do is I've looked and I've isolated some comments on that video, especially comments from members. So by the way, in case you didn't know, if you do become a paid member, it's only $3 Canadian a month, or I think it's $1.50 or $2 US a month. By the way, you do get a special tag next to your name. So when you do put a comment on any one of my videos, you do have priority. Those are the ones I check first. I always have to check the members, the paid members comments first. Doesn't mean I don't check the other ones, but definitely have the priority. So I just want to review some comments that have been made on this video, along with my responses, and hopefully I could give some more details here. So that's a general premise for this video. No editing or anything. I'm just gonna wing it so I could get out as soon as possible, probably this Saturday here. So I'm filming this on 31st of July. So let's start with this comment here. The total return with NAV dropping and total return for the past 3 months of dividends, I'm assuming it mentions with dividends, is 0. Look at YMAX. I bought at 1050. Now the NAV is 1850 and my net total return is 0. That's with the drip on. So I'm not sure maybe why they mentioned YMAX in this video, where it was about the Defiance ETFs, not about the yield max. But I'll focus on, maybe they meant to say QQQY, but I guess not, because the price is right. The price is the YMAX price. But anyway, my response for this comment is, because it's very important, because I've seen other comments like this, okay, similar comments about QQQY. QQQY is beating QQQM in the last 3 months. That should really tell you a lot. Can you really figure it out? Now, when I do comments like that, it's not trying to be insulting or anything. I'm trying to incite you to use your brain to figure it out. That's the honest truth. So why did I mention QQQY is actually beating QQQM in the last 3 months? So in case you don't know, QQQM and QQQ is really the Invesco. It's the index or NASDAQ 100. QQQM is the ETF that has a lower fee. QQQ is the actual authentic index fund. The fee is a bit higher, but either way, though, these are really the two NASDAQ 100 index ETF. So NASDAQ 100, basically you're investing in the NASDAQ 100 without any covered calls, without anything, just the index form, just like if you would buy IVV, VOO, VFV for the S&P 500. So let's take a look at it real quick. So this is the comparison of QQQY starting in April of 2024 until July 26. And what you could actually see is that QQQY, the one that everyone says has a NAV erosion, the one that's going to do a reverse split, which means nothing, is actually outperforming QQQ. This makes sense because in the last couple of months, the Qs or the NASDAQ, they had some volatility that have finally started to go down, some down days. So you could clearly see the evidence, and you clearly see it. Where does it really shine? QQQY, of course, during the aggressive down day. So you just look at the blue, you see how fast QQQ goes down, but QQQY definitely does not go down as much. You could actually see the line is shorter. It still goes down. It's still going to follow each other, because remember, you're still investing in the NASDAQ 100, everyone. Very important. An investment in QQQY is an investment in the NASDAQ 100 with a specific covered call strategy, with a particular option strategy. And that goes for GPIC, JEPQ, IQQQ, QQQI, QYLD, QYLG, all of them. Right? Remember, you're still investing in the NASDAQ 100. So your number one indicator of performance is going to be what the NASDAQ 100 does. So if the NASDAQ 100 starts having volatility, starts going down, having a few bad days, the ETF that writes a lot of calls like QQQY and that's making a lot of premium will start outperforming in that time frame. You could clearly see it here. But if we look at since inception, it's a different story, right? So obviously QQQ is beating QQQY if we compare the start dates from when QQQY came out. Remember, when you do a comparison, you always have to use the same start date and end date. So it's QQQ is obviously outperforming QQQY as of now, and I think it will continue to do so if the Nasdaq 100 keeps going up over time, which I think it will. Not in long term is what I mean, right? So it's very, very important to understand this. I just wanted to show you that. So when people have a comment like this, you have to remember that whether it's QQQY or YMAX, the performance is still tied to the underlying asset. So the truth of the matter is, if you would have bought QQQY instead of QQQ on April 1st, until now, you would be better off. You would have higher return because it's the covered call version. Anyway, moving on now. Let's move on to the next comment here because I want to get through them. I don't want this video to be a million hours. I would be, here's another member here. I would be a lot further ahead by investing elsewhere. Right now, I've collected $5,440 in dividends, and my position is down 51.19. So I've actually made $320. At least I didn't lose money, but certainly didn't make much. What's too good to be true usually is. Someone else agrees with them here. My response is, look, it's really not a matter of too good to be true. I hate that expression. I think it's really stupid in investing because people typically say that honestly when you really don't understand the fund and its objectives, right? And it's exactly what I write here. It's silly to think that if you understand the fund and the strategy, understanding the fund and the strategy will solve all your problems in investing, right? So QQQY is a very, very specific objective. And again, this person here seems to have, I don't know since when they've invested, but again, if you would have started investing in April 1st, if you would have started your NASDAQ 100 position in April 1st, and put it in QQQY instead of QQQ, you would have definitely be much better off with the QQQY. So it really depends what the NASDAQ does. You got to remember that as well. It depends what the underlying is doing. You can't expect QQQY to make a lot of return when the NASDAQ is going down, right? Next comment here from also a paid member here. It's stupid to pay out from capital amount to show more yield percentage. Showing higher yield attracts more investors. That could be true. But once people come to know there is an erosion of capital, I believe that's a myth. They will stay away from such investment. I believe you sold all your QQQY and bought QQQT for more stable dividend and growth. So I would say, just to respond, it's not stupid. They don't pay out from the capital. They are simply paying out all the premiums earned. That's what I wrote here, right? I explained it several times, talked to Sylvia about it, talked to Jay about it. This was confirmed. There is no erosion. They're not doing ROC or return of capital. They're making so much premium. They're paying it all out. But remember, QQQY, why is the stock price going down? Because it's capping the upside of the NASDAQ while capturing the full downside. I repeat. And this goes for any covered call fund, but especially so if you're writing a lot of covered calls. If you're writing a lot of covered calls like QQQY, and this is it's reset daily, you're not getting much upside when the NASDAQ goes up, but you're capturing the full downside. But those premiums mitigate the downside, right? That's true. But the premiums are all paid out. So if you understand that, you know that the value or the net asset values has to go down over time. The stock price has to go down over time because it's paying out all the premiums, right? So capturing all the downside, not capturing much of the upside, and then all the premiums are being paid out. So those premiums is the downside protection or is the downside cushion, but you won't see that translated in the stock price because every month they give it all out, all the premiums they made. So that's very important, and keep that in mind because we're going to look at how QQQY behaves for 5 days compared to other covered call ETFs and compared to QQQM. This is very insightful. I've done it before, but I'm going to do it again. Let's go to the next comment here from David Anderson, another member. As an example, if total return is 15%, what's the point of fooling myself with a 60% yield? There's no fooling, right? Again, the fool is the one who doesn't understand the fund, and the yield, that's the NAV or the stock price combined with the yield or the dividends, that makes the total return. So what really matters is that 15%. The yield is irrelevant and the stock price is irrelevant looking at those alone. If you're looking at only the stock price, if you're looking at only the yield, it makes no sense. It's very silly to do that. The return is what counts, and that's both put together, right? Very important. That's why you see QQQY has a positive return on their website, right? If you go to the website and just look at the return since inception, this is cumulative return. They don't have an average annual yet because hasn't been a year. It's positive 18% cumulative return. This is with the dividends being reinvested, of course, but the return is positive, even though the stock price is just going down and down and down. And I believe it will keep going down forever. And they're going to have to do multiple reverse splits. If you understand the fund, guys, you know that eventually, and I spoke about this with Sylvia, she didn't really want to say it, but she knows it's true as well. Same thing for YMAX and many of the yield max ETFs. Okay, if you're getting these 30, 40, 50% yields, I promise you at some point in time, there's going to be a reverse split again, and they're going to have to keep doing it because they're paying out so much income. You have to count that income as part of the return. If you're just going to spend it, which is your choice, I like that you get the choice. QYLD does not give you a choice. They reinvest half of it for you. But QQQY, they can make a QQQZ fund tomorrow, and it's basically QQQY's strategy, and they don't give out any income. So what's going to happen with that stock price? It's going to go up over time because it's not giving out any of the income. So even though the return is going to be the same, the strategy is going to be the same compared to QQQY, more or less the same. The stock price is going to look very, very, very different, and they wouldn't need to do a reverse split. So you have to keep that in mind. This is very, very, very important to understand, everyone. So you can't just look at the yield. You can't just look at the stock price. You got to look at the total return, and you got to make sure that you understand the fund's objective and strategy, right? Yield is part of the return. Here is a nice long comment here from White Tiger. This is important to understand too. This has to do with the reverse split. This is all true. The value of the investment does not change on the reverse split. Just the amount of shares we hold decreases. That's correct. You know, you'll lose a third of the share count will drop by a third. They will go down, but the distributions will triple as well. So. And you know, I'm ahead of myself, but let me finish the comment here. If we are collecting a set dividend on the amount of shares we hold, then the reverse split decreases the amount of shares we hold, and therefore the amount of dividend becomes less. And that is where I see an issue for myself. So that's actually not true. The dividend does not become less. It remains the same. The dividends and the yield will be adjusted in proportion to the reverse split. So what we will probably see when QQQY, JPY, whatever the next one, the Russell one does the reverse split, the price you'll lose, you'll drop your share count, but the stock price will triple, and the distribution will also triple, right? So even the distribution and the yield will be adjusted just like the stock price is adjusted. So the dividend and the yield will not change either. So this is what I wrote. The distributions do not decrease. With the reverse split, they will actually be adjusted in proportion. They will triple in this case. Same with a forward split, right? A 10-for-1, for example, would shrink the dividend by 10 times. So it's the same thing. Again, very important to understand the distribution and the yield will not change. Yes, the number is going to change, but it's going to match. It's going to change in proportion to the share price changing, which in this case is going to triple. So the distributions will triple as well. Next comment here. Here's another quick one. SPY-T is the only one worth having. If you always have to reinvest 85% in order to keep your position size the same, what is the point? It doesn't work. The point is you like the strategy. It's not a matter of worth having or not. Maybe for you it's not worth having because you're living off the income or you need some of the income. And this is why I made the video where I discussed this, where something like a QQQY, it's not ideal to live off of. It's ideal if you like the strategy, you're a bit more of a pessimist, you want to make a lot of premium, you don't really, you want, maybe you're okay with capturing some of the upside of the NASDAQ 100. You know, someone who wants to invest in QQQY, there's a very, very simple reason. You understand and like the option strategy. The option strategy is very clear. They are not capturing all the upside of the NASDAQ 100. It's reset daily. They're only capturing some of it, but you're making a lot of premium. So if you understand the fund, the best way is to drip all of it. It's not really ideal to pull the income out, although you can do that. You'll have to manage it your way. You'll have to probably reinvest most of the distribution if you want to keep your investment value the same or stable. But you can't just spend all of QQQY's dividend every month and expect the capital in your account to stay stable. Remember, your investment value is all that counts, everyone. The investment value is your capital plus all the dividends you got. If you're spending all the dividends, it's not the fault of the fund, that's your fault. So you gotta own QQQY if you understand the strategy and you like the strategy. And in my opinion, the best way to play it is to drip it like I was doing. So yes, I did switch QQQY to QQQT, but it had nothing to do with the reverse split. I actually did it before the reverse split. It's because I like QQQT's option strategy better. It's still a daily strategy, but it simply captures it. You get less premium. You get still nice yield of 20% target, a lot less premiums, but you capture more upside of the NASDAQ. So if you want to capture, it all depends what's more important to you. Capturing more upside of the S&P or the NASDAQ or the Russell, or you're more pessimistic, you rather have more premiums, right? And capture more premiums. So it's really, you got to figure out the strategy for you. I'm very bullish on technology stocks, so I went with QQQT because I love the daily option strategy, but I want to capture more upside, and QQQT captures more upside than QQQY. That is really why I switched. All right, so let's see if there's any other comments here. I think there's one more, and then we'll look at another thing that's interesting. So here's another one. Even in terms of total return, the QQQY from Evolve is performing better than this one, so I sold this and bought that. So QQQY, there is a QQQY from Evolve listed on the Canadian stock market, and basically that ETF, and I'm planning to do a video on that eventually, is the NASDAQ 100 index, but only the tech stocks, or only the tech stocks of the NASDAQ 100 index. So of course, QQQY from Evolve is going to do better than the NASDAQ 100 if the tech stocks are really doing amazing in the NASDAQ 100 index, right? So you're just isolating the tech stocks with QQQY, but you're taking more risk because QQQY from Evolve only has the tech stocks. It's less diversified than the NASDAQ 100, right? Because you don't have Pepsi, you don't have Costco, you don't have the healthcare companies, the utilities, and I know there's not much, and it's mostly tech. But QQQY from Evolve basically takes out all the non-tech companies. So if tech does really well, of course QQQY is going to do better. But the opposite is also true. If the tech stocks start slumping, doing really bad, well, the NASDAQ 100 is going to do better than QQQY, right? So that's fine if you like QQQY from Evolve over QQQY from or a NASDAQ 100, but just know you're taking more risk, and you're isolating yourself to only technology stocks, right? So that's exactly what I basically say in my comment. So last thing I want to go over with you, and I've done this before, but I feel it's very important. One of the best tricks or hacks to understand how a specific covered call ETF or index-based covered call ETF works is put them all in your phone, in your watch list, and look at the behavior every day. That's the best trick I could give you. So this is what I've done. So what I've done is I put at the top here, you have QQQM, which is simply the lowest fee NASDAQ 100 ETF. It's an index ETF, okay? And then under it, I put all the NASDAQ 100 covered call ETFs that I'm interested in. And you could do the same thing for the Russell. You could do the same thing for the S&P 500, right? You put VOO or IVV at the top, and then you put JPY, you could put JEPI, you could put SPY-T, you could put iSpy, the NEOS one, all of them. You put all of them, and at the end of every day, look at the behavior, and you will you'll be able to figure out how they behave. And the trick is, how much upside am I giving up? That is really the key to understanding these covered call ETFs, or the strategy between them. The more upside you give up, the more yield and the more premiums you're going to collect, which means the fund should typically do better in a down or flat day. But during a really good day, strong day, it's going to do not as well because you're giving up more upside. So think of it like a scale, and the more you give up, the more premiums you're going to get. The less you give up, the less premiums you're going to get, but the more upside capture. So it really depends how bullish or which strategy you like the best on these indexes. So let's go through a few examples. I did this before. So let's take this is a pretty good day. It's not a crazy good day for the NASDAQ, but it's a good day. The NASDAQ up 1.14%. This is the NASDAQ 100 index, QQQM from Invesco. Basically follows the NASDAQ 100, up 1.14%. So you see, QQQY is going to perform not great because it's an up day, and QQQY caps its upside every day. So QQQY is definitely one of the worst performing NASDAQ 100 here. It's still up 0.40 basis points, but it's giving up a lot of upside compared to something like a QQQT. Same, it's still the NASDAQ, still Defiance, still a daily strategy, but you see that the QQQT has captured 1.08 out of the 1.14, so it captures a lot more upside than QQQY. Then you could see the other ones as well, right? And it's not always perfect because there is after hours trading as well, but looking at it every day, at the end of every business day, you more or less you get the same behavior. I'm not saying it's perfect or does the same behavior every day. There's some weird stuff that happens sometimes, but most of the time it behaves similarly. So you see QDTE up 73 basis points, so definitely capturing less than QQQT. The ProShares one is also another daily strategy one, and the ProShares one, by the way, has the highest daily option performance out of all the daily options ones so far, but they have a very small yield. So I know for a fact, or I'm guessing that the ProShares ones captures a lot of the upside, and this is the case. Captured 1.09, just a tiny bit higher than QQQT, almost the same as the NASDAQ. But anything that does a covered call daily strategy, it's impossible for it to capture just as much because there's a little cap there. So GPIC, JEPQ, you see 49, 73 basis points. Let's go to another day. Here's more or less a flat day. You see that the NASDAQ 100 only went up 25 basis points, so almost nothing, a very, very flat day. And here's one where it's weird because I find QQQT should actually be a little bit higher than that. I find it weird. Maybe after hours it went up, but this is a day where, let's stick with the QQQY. This is a day where QQQY, it does the best. And as you could see, if you look at terms of percentages compared to the other NASDAQ 100, it's done the best, right? It's capturing 0.40. This is because it probably captured this 0.25, plus it made the premium. So it captured 0.40. So in this day, QQQY beats everybody. And QQQY will probably beat everybody, in my opinion, in a flat or down day. Let's go in a down day, not a super crazy down day, minus 54 basis points. But let's check it out. You see that QQQT is down less, right? The covered call ETFs are down less. JEPQ, especially because JEPQ is the most defensive one, in my opinion, because it doesn't have the entire NASDAQ 100. The other ones are. But you see QQQY did really well today. So instead of going down 0.54% like the NASDAQ 100, it only went down 0.13. So big outperformance in one day for QQQY. It's definitely one of the best, if not the best one, second none to JEPQ. Let's go to another up day relatively not super sharp up day, 0.62 up. You'll see that again, QQQY is going to underperform. It's capturing less. QQQT captures a little bit more. QDTE captured a bit more. IQQQ, etc., etc. So this is the days where QQQY will underperform during a good day. Here's another strong day, up 1%. You see QQQY can only go up 0.42. It's pretty much, it's capped, whereas QQQT captures more of that upside, not the entire upside, but that's basically what happens. And of course, the ProShares one, almost the same as QQQM. So this tells me again that the ProShares ones, and there's an S&P 500 one, captures most of the upside every day of the S&P and QQQY, and you'll have, but generates a very small premium. That's why they only have 7, 8, 9% yield, right? So that's basically it, guys. So it's very important to understand this. It's a hack. I want you all, if you still don't understand these funds. So here's another thing you need to remember. So let's go back to where QQQY did really well, right, during a flat or down day. So yes, you see that it captured, it went down less. That is not because it still went down 54 basis points, right? You have to remember QQQY still went down 54 basis points, or its capital went down 54 basis points. But the premium, the daily premium, is what's generated and added to the net asset value of the fund to make it only minus 13 basis points. Hopefully you understand what I'm talking about, right? So if the NASDAQ goes down 1%, QQQY will go down 1%, but the premium gets added to the fund, so it'll be down less than 1%, right? So down 54 basis points, QQQY will go down 54 basis points, add the premium in there, and now it's down much less. But here's the key to remember. QQQY pays out all the premiums it's earned at the end of the month. I repeat it. It pays out all that premium earned. So this is why QQQY keeps going down over time. It captures the full downside of the NASDAQ 100. The upside is capped, but all those premiums, which is the main strategy of the fund, they're paid out to you every month. Very, very important to understand. So final comment, I think this is really cool just to drop off here. It is really simple, guys. It's really simple. If you don't understand how these ETFs work, don't invest in them, and even better, or expect something from them that they don't offer. This is a fantastic comment. I wrote hallelujah here. So this is why I keep repeating, and I will keep repeating. You have to understand how these funds work, and you have to really like the strategy. It has to jive with your investment objectives and how you see things, how you see the market. And remember that investing in any one of these guys, any one of these, is still an investment in the NASDAQ 100. So that will be your primary driver of return. During a time frame where the NASDAQ 100 is on a rocket ship, of course the covered call ones are going to underperform. And of course the ones that do more covered calls will underperform even more. But the opposite is also true during the bad times, right? So you got to remember that. What kind of investor are you? How do you see the NASDAQ 100 in the next year, 5 years, 10 years? And that should give you a good indicator of which one to pick, or a combination of ones. And hell, if your total return is all that matters, you have a long time frame, the best option is probably going to be, of course, it's going to be the index fund. It's going to be QQQM, right? I've mentioned this before. So hopefully this video was informative for you. And I do highly recommend, if you want to learn more about this topic of NAV erosion, I do have 2 NAV erosion videos where I discuss these concepts in detail. I'll put the links in the video description below. I'm out of breath. Give me a thumbs up. I would really appreciate it. See you next time.